Hello, everyone, and welcome to this edition of Investing and Trading Live. My name is Josh Lilquist. Today is Friday, last trading day of the week. No, is it Friday? Yes, it is Friday, last trading day of the week. The days go by so fast, sometimes you just don't remember what day it is. But the 22nd of September. All right, so a couple things we're going to do here today on the show. One, I have special guest Luke Young. We're going to do some analysis on the S&P 500. The ETF for that SPY, Upstart. We'll look at Nike. We'll look at UPS and do some different analysis on those, probably mostly with options, but we'll do some of that. We'll get him on the show here today. And I'll start off with a quick market update. That way we can check out and see what this mid-morning update or market is actually doing here. So let's get into that update first. S&P 500 currently at 433.85. Showing some very bearish pressure here the last 2 days, but yet today it gapped up and it's showing some strength here on Friday. So we'll see. We are getting near that daily demand zone that we've been talking about for, I would say, a month at least. So some opportunities potentially here coming up with the S&P 500 ETF moving forward. If this continues to drop a little bit, might be able to get it at a little bit of a discount. The Dow Jones Industrial Average currently at 341.23. This one, same thing, bearish pressure, strength on the day out here on Friday. And the Qs, which is the NASDAQ, same thing, bearish pressure the last couple of days, especially after Fed Day. Continued that on Thursday and gaps up on Friday with some strength into the mid-morning hours. It is currently 10:33 here Central Time. In some people like to call it Minneapolis, and it is not Minneapolis, it is Minneapolis. So that being said, there is risk in trading. This is strictly for entertainment purposes only, mainly mine, but hopefully you find it entertaining as well. Let's bring Luke on the show. Luke, how you doing today?
What's up?
Hey, so I guess that what's up there? You didn't answer my question. How are you doing today?
I'm good.
Okay, a man of a few words, but let's get some analysis here today. I know you had a few stocks that you want to talk about here today, and we'll just do some quick analysis. One of the ones I wanted to talk about starting out is just because the S&P 500 has been showing some great volatility, big moves in the markets. You identified some opportunities, some zones this past week. Just talk a little bit about the S&P 500 and as far as whether it's a short-term market or is this a long-term buy and hold?
Well, the S&P was bouncing. It has continued to fall from that weekly supply zone that was. I mean, we've been talking about that for weeks now.
We identified that, I want to say a couple of weeks ago, back around the 453 area. Actually, no, yeah, the 451 to 460 zone that we had talked about. Still on the chart here. For our YouTube live viewers, I'll bring the chart up and you can see that right here.
Yeah, and from that price, I mean, if you go down to a daily chart, you can see how prices kind of formed somewhat of a downtrend.
Mm-hmm. It did break that zone or that low.
It's a very key level
of 433.
Mm-hmm. And that demand zone you have, can they see your screen?
Yeah, I got it live on the YouTube. By the way, we're live on YouTube and on the podcast, Investing and Trading Live. Anywhere you listen to podcasts, make sure you smash that subscribe and like button and follow the show on Investing and Trading Live.
Yeah, so I like that you're plugging yourself too. It's like an advertisement.
It was kind of a sneaky one, but you caught that, didn't you?
Yeah, nice. It's like radio time. But this demand zone on S&P you have, prices already hit that, and it doesn't reflect that on the actual stock chart. But if in the futures market, if you pull up the ES last night, that demand zone was tested. So price being up today is a reaction off the recent demand bounce.
You're talking about right here.
No.
What time zone? This is the ES.
Go to I think it was maybe a 4 hour, and that's a continuous chart. So go to the actual. I think it's the contract date right now is Z.
This will be very similar. So you're talking about this zone right here.
Yeah.
Let's mark it out for our YouTube viewers.
So it'll be interesting to see what happens, especially next week. Is price going to continue on? To another supply zone, or is it going to break those supply? Is it going to break the current demand it's in? It's kind of in this like sideways, interesting format, but there's really no indication to go long or short just yet.
Okay, I like that. So sometime, and I think we talked about this on the last show, I know you made a couple trades on the S&P 500 this week, but when there is not an opportunity, it is okay to not be in a trade in an investment. So I like that analysis there. Thanks for that one on the S&P 500, SPY, and the ES, which is the futures contract for the S&P 500. Now, there's a couple other stocks I want to get into. Let's look at Upstart. I know we talked about Upstart back, I want to say it was, actually, I have an arrow on the chart here for our YouTube listeners, viewers, Friday the 25th. And we had a demand zone where you had small risk and your reward is probably probably 1, 2, 3, 4 times that much, right? Now, this looks like to me a trade that didn't work out, which not every single trade works out. And I like that we brought this up today because minimal risk. So you're when you're doing your trades and investments, why is it so imperative to have that small risk and high reward to keep going in the markets?
I feel like our trading strategy is very similar to like a hedge fund or a big bank, because when you lose, it's very minimal. Like you were saying, it's small losses, and when you win, your loss or your wins are much greater, like a 4-to-1 or 5-to-1 of what you risk. And if you go and you kind of Google, let's take what's a hedge fund for an example.
I have no idea.
Pull up a bank or Warren Buffett's trades. You'll see on the profitable days of when these guys win, there's very, very large wins. And when they lose, which they lose a lot, it's very, very small losses. And that's kind of the model that we follow when you set up some of these trades. You're risking minimal, 0.5, 1 to 2% of your account. And when you're right, you make, 4 or 5%. And if you do the math, you can literally win 30% of your trades and be profitable. So these people, we've mentioned this before, but these people on YouTube and Twitter or whatever that brag about their winning percentage, don't listen to those guys. Somebody with an 80% win percentage could technically be negative if they're targeting a 1-to-1.
Yeah, and by the way, there are strategies that can have that very high win rate. But the problem is when you have, say, out of 10 trades, you have 8 winners, 2 losers in those type of strategies will basically wipe you out. So that's why what we train and teach here, we're part of a business here, but we always train low risk, high reward, high probability entry points in the market. Something interesting here. And you asked me to Google hedge funds. And here is a headline which kind of contradicts what you were telling me there. It says, here we go. Hedge funds, high risk, high reward investing. So Google is always telling us what we want to see and hear. So the reason why this, in my opinion, says high risk is because they're using leveraged assets in this. And the uneducated eye or the uneducated retail investor thinks that as risky, which there's risk in everything. There's risk in stock, there's risk in options, futures, Forex, doesn't matter what you trade. But if you don't understand how to minimize that risk and manage your risk in your trading strategies, that's the difference. So Google will always tell us as the public things that they want us to see and hear.
Leveraged assets in general, like futures, Forex, and options are seen as high risk to the general public. But you and I both know they're probably lower risk than the actual stock market.
Well, really, you can use less capital.
Right.
So let's say, for example, in the options market, by the way, a lot of people say, oh, options are so risky. They were actually created to minimize risk. For example, if you were to, let's just do a little analysis right here. Let's look at, well, heck, since we were talking about the S&P 500, let's just go look at the S&P 500, the SPY, which is the ETF for the S&P 500. Now, to buy the stock, and do you have a calculator on your phone, Luke? Because I am very bad at math. I will pull the chart up here for our YouTube list viewers. And we're looking at the S&P 500 ETF. So current price is at $433.88. So let's just say you wanted to buy 100 shares of that. What is the math on that?
433
433
times 100
times 100.
Considering you have no leverage. And
which
stock.
Basically stocks.
Yeah, they give you like 2 to 1.
Well, what do you do? But let's just not even consider that. Okay.
Yeah.
So what does that come out to be?
$43,300.
$43,300 to buy 100 shares of that. So I'm going to pull up an options chain for the S&P 500. And let's just say I wanted to do that same price within the options market. And I'll look at an 84-day option just as an example here. And to buy the call on that would be $15.48 per share at 433, at a 433 strike. Okay. What is the math on that? So one contract controls 100 shares. So you're paying $15, we'll say $15.50 to make it easy, times 100. What is that?
$1,500.
So to control the same 100 shares in this market, in the options market, you're only tying up or using $1,500. Okay. Now let's go a little bit further on that. So basically, that's using much less capital to control the same amount of shares. Let's go a little bit further on that. What is your risk on the S&P 500 in that example if you had no stop loss?
If you had no stop loss and price of the S&P went to zero, you would lose $1,500.
No, in the S&P 500 ETF,
Stock?
just buying it outright.
Buying the stock
Yep.
and price went to zero, you would lose the $43,000 that you put in.
Correct. And since Luke already let the cat out of the bag, in doing the option, your risk is only that $1,500 that you paid for that option. That, my friends, is why options were created to minimize risk in the financial markets.
I don't like cats.
What's that?
I don't like cats.
Cats?
You said I let the cat out of the bag.
Oh, you don't like cats? Okay. Well, what do you want to call it then?
I don't know.
The coin out of the bag?
The Giants.
The rabbit?
The Giants. We never mentioned about their.
Oh boy, yeah. This is a financial show, but we actually had a podcast a while back, and I explained why. And I actually invited my good friend Deion Sanders and Ben Lieber and Paul Allen to come on the show. I have not heard back yet, so if you're listening, you guys, I would like to call back on getting on the podcast to go over the similarities between football or sports, having plans, and investing. It's very, very similar. But yeah, the Giants last night, were they 0-3? No, they did win again. They beat the Redskins last week, but they didn't look very good last night. What do you think's happening there?
I think, we can compare them to somebody that risks their entire account. It's just somebody that doesn't know what's going on, especially the coach. I mean, we're running the ball on 2nd and 18. What are we doing?
That's true. And without their star running back, Saquon Barkley, because he's hurt.
It's a dumpster fire over there.
Kind of like your fantasy team last year, wasn't it?
Yeah, I went 3-13 in our our league here, but I'm bouncing back.
You're bouncing back. All right. Well, I'll take that for what it's worth. All right, let's get back to some analysis here. We could talk about football all day. That being said, they're not just quitting though. You got to give it to the Giants. They're gonna go back to the drawing board. They're gonna watch film, and they're gonna do everything they can possible to create a plan to be ready for their next game, which is what you got to do, and that's how you have longevity. That's why they're still a football team, the New York Football Giants, as my good friend Chris Berman would call it. All right, we have a couple other stocks we want to look at. You wanted to look at, was it UPS?
Yeah, we've been talking about that for a little bit.
We did, and we had not a bet going, but we did have a little friendly wager on what UPS would be doing. I was saying that them by paying their workers more. I think the minimum salary is what they said was like what, 160,000 or so, which was up I don't know how many percent, but I thought that was a good thing for the company. That being said, you were saying that's probably not going to be very good, and you had actually some opportunities with UPS, didn't you? So why don't you just talk through UPS a little bit?
Well, a supply zone formed on UPS, and without any of the news, the chart actually looked just really good to short, to the downside. So I got shorts. I think at the start of this week or late last, and just going to continue this thing down. And if you look on this chart, it's pretty interesting. If you go to a daily,
yep, here's the daily right here,
and you look down and to the left, look for quality to demand. I think there's no demand until $120 on this chart.
Yeah, and I do actually. That's a really good demand zone. So is that something as like? By the way, this is just analysis. This isn't any recommendation for buying or selling for UPS. But I like that as maybe a target even.
That's where I'll target. But if you look at a chart like this, with very minimal risk to the shorting side of this, look how much upside you have. If you brought price down to 20%, you're catching a 25% move on the actual stock to the downside. Um, you can imagine it's is that a 30% move?
22. Well,
22
from
okay.
current price, it's 22%.
So it's 22%. Imagine if you were just shorting the stock, you catch 20%. That's what people shoot for in 2 years of investing with a hedge fund.
Sure. Are you talking about doing some options on that though?
Yeah, but now imagine using a leveraged asset, what that return could look like if you were correct in direction.
Yep. I like that.
So I just wanted to point that out.
Yeah, no, that's a good analysis there. So that's UPS. I mean, but also think of it two different ways. Prices go up, prices go down. It doesn't matter what price does. It's going to be showing us an opportunity in each direction, right? So that being said, there might be a possible buying opportunity at $120, and you are buying UPS. And this, like I said, this is just example, not telling anybody to do this. That example would be buying UPS at a discount of about 50%, which is what you're looking to do. But you don't want to just buy something just because it's low, because what is going down can continue to go down further. So trust your analysis, trust your charts, use your analysis, and have low risk, high reward, high probability entry points in the markets. Don't just go blatantly buy or sell any stock or any ETF or futures contract, whatever that you're looking to trade.
Kind of wanted to point this out too. If you pull up a chart of the S&P 500, which basically maps out the entire market,
here's the SPY,
and go back to when we were in dark times like Corona.
2019.
So, right during this time, Josh, I know you can agree on this. You see that big price drop.
Yep.
So during that time, there were a lot of like new traders or investors, people trying new things who thought they were on the top of the world because they bought stocks or the S&P 500 down at this, what is that, 240 range?
Yeah.
Price went up and, they made a good return. And ever since COVID corrected itself and the market has, gone up and down, and stocks have corrected themselves and gone up and down, you don't hear about any of those Corona traders anymore.
Yeah, well, a lot of that's Reddit fueled, and I don't see any Reddit news or anything. To have longevity in the markets. It's not just buy and hope it goes up. You got to have risk management strategies, as we were talking about earlier.
Yeah, it's like to stay alive in this market, to stay consistent, you have to take advantage of both up and down opportunities, which is why it's so important. But I just wanted to point that out. You don't hear about a single one of those coronavirus traders anymore. They're gone. It's like they got COVID and never recovered.
Yeah, well, we want to talk. We don't want that to happen, but
I had COVID a few times. It's just a cold, Josh.
Yeah, I know. All right. So we'll move on from that. This is a family show. All right, I want to look at Nike. So we've been talking a little bit about Nike here, back and forth a little bit, and I really like Nike as a stock longer term. Now, we were looking at some options opportunities with Nike here, and there was some, one of the things that I like to do is collect premium on selling options, and there was a demand zone that I liked that's roughly about 9% away from current price. Volatility has been increasing. It's actually giving some okay premium. And looking at an options chain, and this is live, currently the 84s are giving you over 1% of a return, which is a good thing, right? Now, and I'll put a line on our chart here for our YouTube viewers. This is the 84 price right here. So price has got to drop here about 9% or so to get down there, and offering 1%, which is good for 30 days. Or actually 28 days. That's a good rate of return for 28 days, in my opinion. Now, one of the caveats here is, what's nice about some of these platforms is they offer you different insights on what's coming up, and they actually have the earnings dates right on the calendar here on the chart. They have earnings coming up here on August 23rd. Now, I don't like to put a lot of not August 23rd. September 28th. And
next week.
next week, and you don't really want to put news or fundamental analysis into your investments, but they can give you an indicator as far as what you might be wanting to do, because you always want to minimize risk in the markets. Now, that being said, if you guys remember Dick's Sporting Goods, we talked about this a while back. Dick's Sporting Goods had terrible earnings, and they're talking a lot about the retail industry, about theft and all this stuff, and that was the cause. They dropped 26% in almost overnight. Now, with earnings coming up on with Nike, you actually increase your risk as well, because with earnings coming up, that could happen again. So what are your thoughts on doing options before earnings, even if it's 8, 10, 12% away from that price, that strike price?
I mean, it depends. It's risky.
In the environment we're in right now.
In the environment you're in right now, you just saw Dick's report, and they went down
About 26%.
26%. I wasn't paying attention too much, but
You were looking out the window.
some pretty girls walking out there. But similar thing could happen to Nike. So why even put yourself in that position when you can go out? There's thousands of stocks you can look at, thousands of opportunities, and find one that you can get in now where you don't have to worry about losing.
So odds, probabilities, and minimizing risk. And that's really the key of the show here today is always minimize your risk in the financial markets. Now, we haven't done this for a while. We got to do a little bit of a lightning round. It's been a little while. What do you think about that?
Could work.
So let's do a lightning round. I'm going to throw some stocks at you, and I want you to give me your opinion just by looking at a price chart. Buy, sell, or move on. Okay? We'll start with NVIDIA. We're looking at a daily chart. This right here on this side is a daily chart. And this is not a recommendation. These are strictly entertainment, a fun little game we like to do.
Just glancing.
Just glancing at a chart. Buy. Okay. Tilray.
Buy.
Apple.
Sell.
Meta.
Questionable. Sell.
BHG. Dumpster.
Sell and hope.
WWE. Invalid. I don't know if you knew this, but WWE is no longer a stock on the exchange, on the NYSE. The UFC and WWE merged, I think it was last week, or maybe it was the week before. I believe it was last week. And their new stock is called TKO. It's Endeavor is kind of the company that owns about 51% of this. And this is mirroring WWE stock.
So you just told me that news, right? And I'm like, light bulb went off, like, oh, automatic buy.
Okay.
But the chart looks terrible.
Well, over time, we've been talking about this on the show for many, many months, how great the stock has been. But that being said,
if you go to a weekly chart, maybe it looks better. But
this chart now from August 23rd is down 30%. So that being said, are you buying TKO at a discount, or are you letting it go down even further, letting that knife keep falling?
buy.
Nike.
Sell.
Caesars.
Possibly buy.
Disney, and we'll do one more.
Sell.
Sell. I'll give you my opinion on this last one. AMC.
Sell.
I'm going to say don't even look at AMC. We did some options on this that did pretty well here back. If you're looking at the chart back in 27th of June. In June.
Yeah, that looks ugly.
And I said, you know what? It was something that it gave great opportunity. But with AMC, there's just too much risk that's involved with this. I wouldn't even look at this anymore. Yeah, they did a split back on August 24th. And prices have just cratered ever since then, down about 90%. Imagine that, 90%. That's your AMC stock. That, my friends, was your fun little game of lightning round. All right. That, my friends, is your show for the day. We might even hop on for a market recap here, which we always do on the show at the end of the day or tomorrow. Oh, we'll just be playing some other segments here. But thanks for Luke for coming on the show. We appreciate it. I know we try to do this at least once a week. We definitely got to do this a little bit more. It's episode 854, I believe. So make sure to subscribe and smash the like button on the podcast, wherever you listen to podcasts, Apple Podcasts, iHeartRadio, and Spotify. Make sure to check out the YouTube live, the YouTube stream. You can simply just go to Josh Lilquist on that and subscribe to that. You'll see definitely some outtakes on that on the YouTube. Plus, you'll be able to see the charts and everything. That way, you can see what we're talking about. But for you, you podcast listeners, thanks for joining in. As always, collect your profits when they are given to you, and protect your losses, keeping them small. Until next time, retire young, my friends.